How can I minimize retirement income taxes when diversifying? Imagine having a toolbox filled with different ways to get money in retirement. The secret is knowing how to use each tool to keep more of your hard-earned cash. When you think about diversifying your retirement income, you are spreading your savings across different account types that are taxed differently. This is called tax diversification. It gives you options to control your tax bill when you start withdrawing money. Start by understanding the three main types of accounts. First are taxable accounts. These are investment accounts where you put in money after paying taxes. You might pay taxes on earnings or gains each year, but qualified dividends and long-term capital gains often have lower tax rates. When you take money out, you don't pay taxes again because you already paid taxes on the contributions. Next are tax-deferred accounts. These include traditional individual retirement accounts and 401(k) plans. You can deduct your contributions from your taxes now, and your investments grow without taxes until you withdraw. When you do take money out in retirement, it is taxed as ordinary income, which can be at a higher rate. Third are tax-free accounts. Roth individual retirement accounts and Roth 401(k)s fall here. You contribute with money that has already been taxed, but when you withdraw, including earnings, it is completely tax-free if you meet certain rules. This can be a big help in managing your taxes later. To lower your taxes, start by contributing as much as you can to all these accounts. This way, you get the benefits of each type and create options for your withdrawals. For example, hold investments that are tax-efficient, like index funds or stocks with qualified dividends, in taxable accounts. Put investments that generate a lot of taxable income, such as actively managed mutual funds, into tax-deferred accounts to reduce yearly taxes. Another smart move is to convert some of your tax-deferred accounts to Roth accounts during years when your income and tax rate are lower. This means paying taxes now at a lower rate, so you won't pay taxes on those funds in the future. It also reduces future required minimum distributions, which are mandatory withdrawals from tax-deferred accounts that can bump you into higher tax brackets. When you retire, plan your withdrawals carefully. Usually, it's best to start with taxable accounts first, then move to tax-deferred accounts, and finally tap into tax-free accounts. This order helps keep your taxable income and tax rate as low as possible. You can also sell investments at a loss in taxable accounts to offset gains, which lowers your taxable income. It's also wise to plan your asset location at least 10 years before retirement. Think about which investments belong in which accounts based on their tax efficiency. Keep an eye on your income levels because crossing certain thresholds can increase Medicare premiums or other surcharges. Managing your withdrawals to stay below those limits can save you money. By spreading your savings across different account types and managing your withdrawals wisely, you gain flexibility. This helps you adapt to changing tax laws and personal circumstances, keeping more money in your pocket and building a more secure retirement income stream.